Well, the government's policy comes with another twist. It could, with one stroke of the pen, wipe out the mortgage insurance industry. Now, the history of mortgage insurance goes back to 1965, the Menzies government, which created the Housing Loans Insurance Corporation to allow Australian families to buy a home with a smaller deposit. Eventually, those insurers became privatised, but that would change if the current Prime Minister, or the next one, gets this policy through the Parliament.
Today I announce that under a Labor government you'll be able to buy your first home with just a 5% deposit. Our 5% deposit plan will be open to every Australian looking to buy their first home. It will be available for homes valued all the way up to the average price in every city and region, and you won't have to pay a single dollar in mortgage insurance.
In other words, the government would take on the role as the mortgage insurer itself. Well, the Insurance Council today said the move nationalises a long-standing and effective financial product and could also add to systemic financial risk. Well, one company most affected by the move is Australia's biggest mortgage insurer, Helia. Its chief executive is Pauline Blight-Johnston, who joins me now. Pauline, many thanks for your time. Does this mean your industry, your business is effectively wiped out if the government's returned?
Well, it's not wiped out, but it certainly makes it difficult for us to continue to do what it is that we do, which is help Australians into homes. Since 2010, we've helped 1.2 million Australians into homes. We want to continue to do that, and it increases the challenges for us in continuing to do that.
OK, so just explain why it gives these challenges, because effectively the government is nationalising the mortgage insurance industry, is taking on the risk itself rather than you taking on the risk.
That's true for first home buyers, not for all home buyers. So we know that the first home buyer guarantee scheme that's currently in place has taken about 38% of the industry. As we expand, that will go over 50% of the industry. It is still important that the LMI industry is around to support investors and upgraders who all need access to LMI. But without a good spread of risks, it does make it more challenging for us to do that.
OK, so then just take me to this systemic financial risk that the Insurance Council talks about. Why would they be talking about this adding to systemic financial risk in Australia?
Well, for two reasons. One, it does put risk onto the government balance sheet. And I think we need to remember mortgages default at times of economic weakness. So whilst it may look like it hasn't cost the government very much so far, we've been in a period of very low unemployment. When the unemployment rate changes, that could change quite dramatically. And it will also happen, of course, at a time when the government revenue is down and the tax take is down. The second reason is the guarantee provided by the government is nowhere near as strong as an LMI guarantee. In fact, it only pays out, we think, about 40 cents in the dollar of what LMI would pay out, which creates a risk for lenders, particularly smaller lenders.
So that being the case, if they're paying out less to lenders, then the chance of a financial institution perhaps collapsing, if there is a significant increase in unemployment and house prices were to fall sharply, that would either put the risk back on the government itself and or the financial institutions, which are not able to get 100 cents in the dollar if there are losses on mortgages.
Yeah, that's true. And it's particularly important for small lenders who have less access to capital and less ability to withstand variability.
So that would also mean that, I was going to say, that would also mean potentially some may be driven out of the home lending industry, which would mean that there'd be less competition in the housing markets, in the mortgage markets, as compared with today.
That is a real possibility, that we see the strengthening of the big four banks and reduced competition across the mortgage industry. OK, now, does this have anything to do with the fact that the Commonwealth Bank has recently withdrawn the contract it has for mortgage insurance with your company Helia, which has been going back for more than 50 years now, that relationship? Do these things all related in any which way or form? Not directly, because they have decided to insure, or they're going to try to insure it with another party. But I think what we have seen over time, though, is that the bank is increasingly insuring less because they are using the first home guarantee scheme, which is making it harder to negotiate a commercially attractive deal for both parties.
Okay, so because ultimately you've got to make a profit out of the premium and out of income that you have, so therefore either A, if the government steps in, it means that you can't cover the risk in the way in which you have previously, and or if banks start to do this more themselves, then again it means that there's less there for the mortgage insurers.
And you have to remember, insurance is all based on the pooling of risk. The way to run an insurance company profitably and viably and sustainably is to have a wide spread of risks, not just have one type of risks. And so the more that the government takes one type of risk, the greater the risk becomes across the industry.
So just a quick one. If this policy were to get through, will you and I actually be even talking in 2 years' time? Is there actually a business in the future for you?
There's still business, but we will need to look at how we most viably run that and whether we need consolidation across the industry, which is a very likely outcome.
I'll tell you what's interesting stuff. Pauline Blight-Johnston, Chief Executive of Australia's biggest mortgage insurer, Helia. Many thanks for your time today.
Thank you.